All right, welcome. So, you're a student and you're maybe thinking about getting into real estate investing. Well, you're in exactly the right place. Today, we're going to break down something that's super important but often sounds kind of complicated: tax deductions for your rental income. Trust me, it's not as scary as it sounds. By the end of this, you'll have this simple 5-rule framework that'll help you think just like a pro.
Okay, so here's a quick look at our game plan. First, we'll hit the property profit principle. Then, the big one, the 5 rules for deduction. After that, a quick shopping list of stuff you can usually deduct. We'll spend some real time on the difference between capital and current expenses. That's a huge one. And then, we'll wrap it all up. Let's get into it.
All right, first up, the property profit principle. And the main thing to get right off the bat is that this is way simpler than you might think. I get it, tax rules can seem, well, super intimidating, right? And the official forms, they don't exactly hold your hand and show you where to deduct your investment expenses.
So let's just start with a really basic question that gets to the heart of all this. When you get that rental income, what part of it are you actually taxed on? Is it every single dollar that your tenant hands over? Let's find out.
And the answer is a big, resounding no. You're taxed on the profit from the property. So what does that actually mean? Well, it's pretty straightforward. Your profit is your total rental money coming in minus all the related expenses you had to pay out to get that money. For any of you who've taken a business class, this should sound really familiar. It's all about net income, not gross revenue.
Okay, now we're getting to the absolute heart of this whole explainer. Section 2, the 5 rules for deduction. I want you to think of this as your go-to essential checklist for every single expense you might have. So here they are, the 5 big rules. Rule number 1, the expense has to be for earning income. Makes sense, right? It's got to be related to your rental. Number 2, it can't be a capital expense. Now, hold that thought. We're going to circle back and dive deep into that one in a minute. Third, it has to be an expense you actually paid, not just some money you put aside for a rainy day. Fourth, and this is a big one, it can't be a personal expense. So that trip to the beach, probably not deductible. And finally, rule number 5. The cost has to be reasonable. You can't claim you spent $500 on a light bulb. If your expense ticks all 5 of these boxes, boom, you can deduct it.
Okay, so now that we've got the rules down, let's make this a little more real. We're going to look at a sort of shopping list of common expenses that pretty much always pass that 5-point check. Just take a look at this list. We're talking about things like advertising to find new tenants, the insurance you pay on the property, and of course the interest on your mortgage. Those are the big ones. But it's also the smaller stuff like office expenses, pens, stamps, whatever. Oh, and don't forget professional fees for your lawyer or accountant, any repairs and maintenance, property taxes, and even the cost of travel to go manage the property. See, every single one of these fits perfectly into that 5-point checklist we just went over.
All right, remember how I said we'd come back to rule number 2? Well, now's the time. We really need to zoom in on the difference between a current expense and a capital expense. Honestly, this is probably the single biggest thing that trips up new investors, and getting it right is absolutely crucial.
Let's use an example to make this super clear. Imagine you're paying legal fees. Okay, so if you pay a lawyer to draw up a lease for your new tenant, that's a current expense. It's just part of the day-to-day business of being a landlord, so you deduct it in the same year. But what if you pay that same lawyer to help you buy the property in the first place? That's a capital expense. You don't deduct it right away. Instead, it gets added to the official cost of the property.
Let's throw some numbers at this to see how it works. Say you're buying your first rental for $200,000, and the legal fees to get the deal done are $10,000. So what happens to that 10 grand? Where does it go?
Well, that $10,000 doesn't just vanish into thin air. And like we said, you can deduct it from your rental income this year. Instead, you have to allocate it. So if the land is worth, say, 25% of the total property value, you add 25% of those legal fees, that's $2,500, right onto the cost of the land. The other 75%, or $7,500, gets tacked onto the cost of the building itself. This whole process increases what's called your cost base. And trust me, that becomes really important later on when you eventually sell the place.
Okay, here's another classic situation that trips a lot of people up: prepaid expenses. So let's take a look at this example. We've got Maria. She paid $2,100 for insurance on her rental property. But here's the catch. That insurance covers this year and the next 2 years as well. So the big question is, can she just deduct that entire amount right now? And you probably guessed it, the answer is no. You have to match the expense to the year it actually applies to. So since that $2,100 policy covers 3 years, you just divide it by 3. She can only deduct the part that's for this year, which is $700. Then next year she'll deduct another $700, and then the final $700 in year 3. It's all about matching the expense to the benefit.
Okay, let's wrap this up and bring it all home. We're at our final section, the final takeaway. Think about how far we've come. We started with that big, simple idea that you're only taxed on your profit, and now we've drilled all the way down to the 5 specific rules you need for every single expense.
So if there's one thing you walk away with today, let it be this. If you can master those 5 rules, you will master your rental deductions. Seriously. This isn't about trying to memorize some impossibly long list of what you can and can't do. It's about understanding the framework. Once you have that, you can look at any expense that comes your way and know exactly how to handle it.
And that's a wrap for this explainer. But I want to leave you with a little something to think about as you start planning your own investments. Now that you know the rules, what's the very first expense you're going to go back and double-check?